Welcome to our in-depth analysis of Apple Inc.'s AAPL financial health, focusing on its working capital and liquidity ratios. In today's dynamic market, understanding these key metrics is crucial not just for investors and financial professionals, but for anyone seeking to grasp the fundamental strength of a company like Apple. Working capital provides insight into a company's short-term operational efficiency, while liquidity ratios assess its ability to meet immediate financial obligations. We'll explore how Apple, a global tech giant, manages these critical aspects of its balance sheet. This analysis will shed light on Apple's financial resilience, operational strategies, and its broader implications for wealth management and business understanding. Get ready to dive deep into the numbers behind one of the world's most valuable companies.
Let's begin by defining working capital. Simply put, working capital is the difference between a company's current assets and its current liabilities. It's a measure of a company's short-term liquidity and operational efficiency. Positive working capital indicates that a company has sufficient current assets to cover its current liabilities, allowing it to fund its day-to-day operations and potential growth opportunities without financial strain. Conversely, negative working capital, while sometimes a red flag, can also signal highly efficient operations, especially in companies with strong bargaining power over suppliers and fast inventory turnover. Understanding this balance is key to assessing a company's immediate financial stability and its capacity to sustain its operations.
To fully grasp working capital, we need to break down its components. Current assets are assets that can be converted into cash within 1 year. These typically include cash and cash equivalents, accounts receivable, money owed to the company by its customers, and inventory, which are goods available for sale. On the other side, current liabilities are obligations due within 1 year. The most common examples are accounts payable, money the company owes to its suppliers, and short-term debt, which includes loans or lines of credit due within 12 months. The interplay between these components directly impacts the working capital calculation, and how efficiently a company manages each can significantly affect its financial health and operational agility.
Apple presents an intriguing case study when it comes to working capital. Unlike many companies that aim for positive working capital, Apple has often operated with negative working capital. This isn't necessarily a weakness. For Apple, it's a testament to highly efficient supply chain management and immense market power. They can negotiate extended payment terms with suppliers, leading to high accounts payable, while simultaneously maintaining very low inventory levels due to strong demand and rapid sales cycles. This strategy means that instead of tying up cash in inventory, Apple keeps more cash on hand or invests it, enhancing its overall financial flexibility. This unique dynamic highlights how context is paramount when interpreting financial ratios.
While working capital gives us a general overview, liquidity ratios offer a more precise lens into a company's ability to meet its short-term financial obligations. These ratios are crucial for creditors who want assurance that a company can pay its debts, and for investors who seek financially stable entities. We will examine 3 primary liquidity ratios: the current ratio, the quick ratio, and the cash ratio. Each ratio offers a progressively more stringent view of liquidity, stripping away assets that are less readily convertible to cash. Together, they provide a comprehensive picture, allowing us to understand Apple's liquidity from various perspectives. The current ratio is the most basic liquidity ratio, calculated by dividing current assets by current liabilities. A current ratio of 1.0 or greater generally suggests good short-term financial health, meaning a company can cover its short-term debts. For Apple, the current ratio often hovers around 1.0. For instance, in FY 2023, Apple's current ratio was approximately 1.07. While some might prefer a higher ratio, for a highly efficient technology company like Apple, this indicates a disciplined approach to managing current assets and liabilities, avoiding excessive idle cash, and effectively leveraging its extensive supplier network. It's a healthy ratio that reflects strong operational management.
Next, we move to the quick ratio, also known as the acid test ratio. This ratio takes a more conservative view of liquidity by excluding inventory from current assets before dividing by current liabilities. Inventory can sometimes be difficult to convert into cash quickly, especially for companies with slow-moving stock.
Apple, however, has highly liquid inventory due to high demand for its products. Yet, the quick ratio provides an even clearer picture of immediate liquidity without relying on inventory sales. For example, in FY 2023, Apple's quick ratio was approximately 0.99. This demonstrates that even without considering its fast-moving inventory, Apple maintains a robust ability to meet its short-term obligations, reflecting its high inventory turnover.
Finally, we analyze the cash ratio, the most stringent of all liquidity measures. This ratio focuses solely on a company's most liquid assets, cash and cash equivalents, and divides them by current liabilities. It excludes both inventory and accounts receivable, providing an extremely conservative view of a company's immediate ability to pay off its short-term debts with only its ready cash. For Apple, while its cash ratio might appear lower than its current or quick ratios, say approximately 0.26 in FY 2023, it's still substantial given the sheer volume of Apple's cash and cash equivalents. This ratio underscores Apple's strong cash generation capabilities, ensuring it can meet critical immediate obligations without relying on converting other assets.
In conclusion, our analysis reveals Apple's remarkable financial resilience. Despite often operating with unique working capital dynamics, including negative working capital, its robust liquidity ratios, current, quick, and cash, demonstrates its exceptional ability to manage short-term obligations. This is largely attributed to its efficient supply chain, strong brand demand, and formidable cash generation. The key takeaway is that when evaluating a company like Apple, context is paramount. Its financial ratios, while sometimes unconventional, are indicators of a sophisticated and highly effective operational strategy. For investors and entrepreneurs, understanding these nuances offers invaluable insights into business strategy and wealth management in the modern economy.